October 24th, 1929, the opening bell rang on Wall Street, and within minutes, the floor looked less like a financial exchange and more like a building on fire. Traders screaming, phone lines jammed. Men who had been millionaires at breakfast were doing arithmetic by noon. By the time it was over, $30 billion had been erased from the American economy. $500 billion in today's money. Breadlines stretched around city blocks. Suicide rates climbed. Families lost in weeks what they had built over decades. That is the version every American learns. A systemic catastrophe. A storm nobody saw coming. An equal opportunity disaster that swallowed rich and poor alike. That version is incomplete. While the market was collapsing, while ordinary Americans were watching their savings disappear, a specific group of men was having the greatest financial year of their lives. Not by luck, not by accident, by design. The crash of 1929 was not just a collapse, it was a transfer, and understanding who transferred what to whom changes everything about how you read American financial history. Start with Albert Wiggin, head of Chase National Bank, the largest bank in the United States in 1929. Respected, celebrated, a man whose name appeared in newspapers next to words like distinguished and trusted. Shareholders had placed their money in his institution. Depositors had placed their savings there. By every external measure, Wiggin was the steward of that trust. Between 1929 and 1932, he was secretly shorting his own bank's stock. Shorting, for the uninitiated, means borrowing shares, selling them at the current high price, waiting for the price to fall, buying them back cheap and pocketing the difference. The harder the stock falls, the more you make. Wiggin held 42,000 shorted shares in his own institution. He was the man running that institution. He had full access to the balance sheet, full visibility into the leverage, full knowledge of how exposed Chase National actually was. He used none of that knowledge to protect shareholders or warn depositors. He used it to place his bet. When Chase National's stock collapsed, Wiggin collected $4 million in profit, roughly $72 million in today's money. His own bank, his own shareholders, his own depositors. He bet against every one of them, collected his winnings, and was then awarded a pension of $100,000 per year upon retirement. It took Ferdinand Pecora, a Sicilian immigrant turned New York prosecutor, to drag this into daylight. Operating the Senate's Pecora Commission hearings in 1932 on a budget that would not cover a single partner's salary at a modern investment bank, Pecora subpoenaed records and put men like Wiggin under oath. Wiggin confirmed everything and then delivered the detail that defines the entire era. None of it was illegal. There was no law prohibiting a bank president from shorting his own institution. The rules had not been written because the people who would have written them were the same people benefiting from their absence. Pecora called it the most reprehensible conduct he had ever encountered. Public outrage forced Wiggin to surrender the pension. He kept the $4 million. If Wiggin represents quiet institutional corruption, Jesse Livermore represents something louder and almost impossible to fully comprehend. Livermore was the greatest market speculator in American history. In 1929, he made approximately $100 million in a single year, $1.8 billion in today's terms. He did it by identifying the structural fragility of the entire bull market before almost anyone else and positioning himself on the other side of it. What Livermore understood, and what almost nobody was willing to say publicly, was that the 1920s rally was built almost entirely on borrowed money. Brokers were allowing retail investors to buy stocks on 10% margin. $100 of actual capital could control $1,000 of stock. On the way up, this leverage amplified every gain. On the way down, it would amplify every loss with identical ruthlessness. The moment prices turned, margin calls would cascade, brokers demanding repayment, investors forced to sell at any price immediately. That forced selling pushing prices lower. Lower prices triggering more margin calls, more selling. A mechanical spiral with no natural floor. Livermore did not create this condition, but he mapped it earlier and more precisely than anyone operating in those markets, and he built his position accordingly. He accumulated short positions quietly across multiple brokerage accounts, used intermediaries to execute trades so his name would not appear, and waited with the patience of someone who understood that the structure needed to collapse under its own weight. When October arrived, he was already on the other side of every panicked seller. By the time the week was done, he had made more money in a few days than most Americans would earn in a lifetime. His wife, hearing the news reports about national ruin, asked if they had lost everything. He told her they had not. He could not bring himself to say the fuller truth, which was that the screaming headlines about American financial catastrophe meant their family had just become extraordinarily wealthy. Livermore's personal story does not end in triumph. Later trades and a chaotic personal life undid much of what he had built. He died in 1940, largely broke, by his own hand. But in 1929, he had correctly called the greatest market collapse in American history and extracted from it a sum with no historical precedent. The question his story leaves behind is one that should sit uncomfortably with anyone paying attention. If Livermore could see the structure of the coming collapse clearly enough to stake $100 million on it, how many other people in positions of institutional power and financial access saw the same thing and simply said nothing? The answer, as Pecora eventually documented, is that the knowledge was not rare. The years before the crash had been defined by a practice operating openly enough among its participants to suggest it was simply considered how markets worked. These were called pool operations, and the men running them were not fringe criminals. They were the financial establishment. A pool assembled like this: a group of wealthy investors, sometimes 10 people, sometimes 30, pooled enough capital to move the price of a selected stock. They accumulated shares quietly in a company with thin enough trading volume that coordinated buying would produce visible price movement. Then came promotion. The pool hired tipsters, paid journalists, newsletter writers with large readerships, radio personalities commanding the attention of millions of retail investors. These promoters would publish breathless commentary about the selected stock. The smart money is already in. This one is moving. Retail investors who heard it and believed it would begin buying. As they bought, the price rose. As the price rose, more investors wanted in. As they piled in, the pool operators sold their accumulated shares into the buying frenzy at the inflated peak, then stepped away. The retail investors who had bought at the top were left holding stock with no organic basis for trading where it did. When the buying stopped, the price returned to reality. The pool moved on to the next target. Between 1927 and 1929, this was running simultaneously across dozens of stocks. Radio Corporation of America, Montgomery Ward, General Motors, Sinclair Consolidated Oil. The roaring stock market of the late 1920s was not primarily a reflection of genuine economic transformation. It was, to a very significant degree, organized syndicates cycling through stock after stock, manufacturing excitement, extracting money from retail participants, and exiting before the structure fell. Joseph Kennedy, patriarch of the Kennedy dynasty, was documented as a participant in pool operations during this period. More consequentially, he demonstrated the most valuable skill available in that environment: knowing when to leave. Well before the crash, Kennedy had been systematically liquidating his stock positions, converting paper gains into cash and hard assets. When the collapse arrived, he was already standing on solid ground. Franklin Roosevelt appointed him as the first chairman of the Securities and Exchange Commission in 1934, reasoning famously that it takes a thief to catch a thief. Kennedy understood the machinery of manipulation because he had run it. He was unrepentant about that history and, perhaps precisely for that reason, well equipped to dismantle it. But the pool operators and short sellers are not the only architects of what happened. There was another structure, more elegant in design and more devastating in its impact on ordinary investors, and it came from one of the most prestigious names on Wall Street. Goldman Sachs, in late 1928, created what were called investment trusts. The concept sounded responsible. A company formed solely to hold shares in other companies. Retail investors could buy shares in the trust and get diversified market exposure without selecting individual stocks themselves. Goldman launched the Goldman Sachs Trading Corporation and raised enormous sums from the public. Then Goldman launched a second trust, Shenandoah Corporation, which purchased shares in the first. Then Shenandoah launched Blue Ridge Corporation, which purchased shares in Shenandoah, each layer buying the layer below it, leverage compounding at every tier. In practice, if underlying stocks fell 50%, a trust at the second level did not simply lose 50%. The embedded leverage amplified losses dramatically through each layer. The top-level trust could lose 80, 90, or 100% of its value from a 50% decline below. The structure was not merely risky in the way all equity investments carry risk. It was mathematically engineered to annihilate retail shareholders under any sustained downturn. Goldman's own partners had received founder shares at steep discounts and had been selling before the crash accelerated. The retail investors who bought at peak prices, trusting the Goldman name, had no comparable insight and no comparable exit. Blue Ridge fell from $24 per share to under $2. The Goldman Sachs Trading Corporation fell from $326 to $1.75 by 1932, a loss exceeding 99%. The economist John Kenneth Galbraith later described the investment trust mania as among the most striking speculative phenomena of the decade. What it actually represented was a clean transfer of wealth from buyers who did not understand what they owned to sellers who understood it precisely. The short sellers and pool operators get most of the historical attention, but there is a quieter category of winner from 1929, less dramatic in method, more patient in approach, and arguably more significant in long-term accumulation. These were simply the buyers, people who entered the wreckage with cash and acquired real assets at prices the boom years would never have offered. After the crash, the physical world remained. Factories still stood, farmland was still fertile, office buildings still occupied their city blocks. What changed was that the people who had owned these things were now drowning in margin calls they could not meet and mortgages they could not service. The desperation to raise any amount of cash at any price created conditions for asset acquisition with no parallel in modern American history. The Rockefeller family chose this moment to begin constructing Rockefeller Center. Land costs were at their lowest in a generation. Construction materials were cheap, workers were desperate and available at wages impossible to offer in boom times. By committing to a major project during the Depression's depths, the Rockefellers locked in costs that the 1920s would have made unthinkable. When prosperity returned, they held assets acquired at Depression-era prices, a permanent advantage compounding with every subsequent decade. The same pattern repeated across industries. Companies that had leveraged themselves during the boom went insolvent and were acquired at fractions of replacement cost by buyers with liquid capital. Bernard Baruch, the financier and presidential advisor, described his exit from the market simply. He had noticed his shoeshine boy was giving him stock tips. When shoeshine boys are offering investment advice, the intelligent move is to get out. He converted to cash and government bonds, held through the collapse, and emerged unscathed. His story is told as individual wisdom. What it illustrates is structural. The people closest to the machinery of the market had been making their exits long before the public understood an exit was necessary. The Pecora Commission ultimately mapped the full architecture of what had happened. Charles Mitchell of National City Bank had sold personal shares in his own institution to a family member at an artificial loss purely to generate a tax deduction, while publicly assuring investors the bank was sound. J.P. Morgan's partners had a practice of offering discounted shares in new stock issues to judges, government officials, and political allies, a system of financial favor granting designed to cultivate relationships that would protect the firm from oversight. The recipients on what Morgan's partners called their preferred list included a sitting Secretary of the Treasury and a former President of the United States. What Pecora uncovered was not a collection of individual bad actors. He was mapping a system, a coherent architecture in which the people managing public money operated on the foundational assumption that their private interests came first, that superior information was a personal asset to exploit rather than a responsibility to honor, and that the regulatory environment was too captured by the interests it was supposed to oversee to represent any real constraint. The system was not being abused. It was functioning as designed. The legislation that followed addressed this directly. Glass-Steagall separated commercial banking from investment banking. The Securities Act of 1933 required truthful disclosure for publicly offered securities. The Securities Exchange Act of 1934 created the SEC. These were not abstract reforms. They were surgical responses to specific practices documented in specific testimony under oath. They worked reasonably well for decades. But the deeper lesson is one the history books consistently understate. The men who profited from 1929 were not operating outside the system. They were the system. Wiggin was not a criminal who had infiltrated Chase National Bank. He was its head, appointed by its board, trusted by its depositors. The pool operators were not running schemes from back rooms. They were operating with the knowledge and participation of the major institutions that formed the core of American financial life. Goldman Sachs was not a fraudulent enterprise. It was one of the most prestigious names in finance, using that prestige as a sales tool to place products it understood in front of buyers it knew did not. None of it was illegal because the people who would have written laws against it were the same people practicing it. Livermore made $1.8 billion in today's terms by betting against a collapse he identified before it arrived. Wiggin made $72 million by shorting his own institution while managing its decline. Kennedy spent the Depression acquiring assets no boom market would have offered. Goldman structured products that concentrated losses in retail hands while its partners had already reduced their exposure. The pool operators extracted fortunes from ordinary investors through coordinated manipulation and exited before the structure fell. The patient buyers with liquid capital acquired the physical assets of American industry at prices that compounded in value for generations. None of these outcomes were accidental. Each one was the product of specific information advantages, specific positioning, and specific willingness to operate within a system that treated ordinary investors as exit liquidity rather than participants to be served. The crash did not destroy wealth, it relocated it. And that relocation followed the same directional logic that defines every major financial crisis, away from the credulous and the leveraged, toward the skeptical and the liquid. The average American investor in 1929 was not foolish. They were acting on the best information available to them, which was the information the pool operators, the bank presidents, and the Wall Street establishment wanted them to have. The error was not believing in the economy. The economy was genuinely growing. The error was believing that stock prices reflected actual economic value, when those prices reflected years of coordinated manipulation and artificial demand manufactured by people who intended to be out before the prices reflected anything real. The 1929 crash was not assembled in October of that year. It was built piece by piece across a decade by people who understood exactly what they were constructing and exactly who would be holding it when it came apart. History recorded the suffering of the people holding the bag. It spent considerably less time on the people who handed it to them. The names change with every generation. The mechanism does not.